some commodities, gold here, I'm gonna be just patient on it because this is basically an impulse move to the upside, right? Okay, this is an impulse move, so we wait. Okay, I always highlight this. Don't jump in a trade after an impulsive move. Okay, the reason for that, right? Let me walk you through a little bit. Okay, now why we don't trade once we only, why we don't trade after we see just only an impulse, right? Because there's only some variations in the market on how price can develop. Okay, now price can either go up, right? Very straightforward, or either come down, right? Or I would say sideways, but sideways usually it slants towards the upside or slants towards the downside. Very, very seldom it goes horizontal. Okay, now why this is important? Okay, let me open up a blank chart. Okay, I think understanding this principle is very, very crucial. Okay. Now, if today you understand that the market can either go up fast, come down fast, go up slow, and come down slow, okay, then you'll be able to dissect how a price chart can potentially form, okay, and then at the end of the day we play around with it as patterns. Okay, now if you know, look at it from a zigzag, or I would say zigzag puzzle piece. Okay, if today you only have these 4 pieces to play with, all you do is a mix and match. Okay, so the idea here is, if today we only get an impulsive move to the upside, okay, what are the other possibility that the market can develop after this? There's only 3 types, right? Either market comes down very fast, or the market continue to go up in a slow move, or the market comes down slow. Okay, there's really no other ways in which the market can develop into, right? Because that's how prices can move. And once you understand this possibility, all you need to then do is just look out for the odds of, after a certain pattern develop, how do price normally react? How do price normally develop? Okay, so the thing here is, again, going back to gold. Okay, if all you have is only an impulse move here, you do not want to trade. Why? Because the reason here is quite straightforward, right? There is 3 possible patterns that the market can develop after an impulse, right? It can either come down slow, it can come down fast, it can go up slow. Okay, right now we do not have that information, and the odds of each of this is probably 33%, 33%, 33%, which means that it's not in your favor. You don't have a high probability potential trade direction to focus on, right? And that's the reason why we don't enter a trade, right? That's the reason why we don't focus on trading when all we have from the market is an impulse move. Okay, but if today the market starts to develop the next piece, right? So now let's say the market develops something like this, then it becomes very clear, because we understand that when the market have this pattern combination, it has a higher chance and a higher odds that it will go up. Okay, and that's the reason why we then have a clear direction of us, right? If the market do something like this, this is another pattern we can recognize, right? If the market do something like that, we have a higher odds that it will come down, and therefore we focus on it. And when I mean high odds, it means that there's a high probability it will develop in that manner because of how historically those pattern has been playing out, right? If today all you see is a V shape here, okay, then there's no odds as well, right? Why? Because this is an impulse. There's again 3 ways the market can develop next, so it's not in our favor, right? So the only pattern that you want to really focus on the potential setup is either this or this, right? And this pattern here we call a crawl, and this pattern here we simply call a impulse correction setup. Okay, so if you take a look at how the price has been developing, historically, okay, so you can see over here, we don't need to go very far back, right? You can see over here in this combination, impulse, correction, slow move to the downside, continuation. Very clear cut, right? Okay, go back a little bit. You can see here V-shaped formation, not to be trading in this entire environment, okay? Because again, the odds is not in our favor. Going back a little bit, right? Look at this here. Fast move up, correction, slow. The market actually do a significant pullback. Okay, so that's how pattern plays out, right? You want to recognize what are the pattern developing, okay, and you just leverage on that, right? So I always say in trading, at the end of the day, you are basically recognizing certain patterns that has these two elements: repeatability and reliability. Okay, repeatability means that the pattern needs to repeat itself sufficiently for us as traders to take advantage of it. Reliability means that it needs to have certain sense of consistency in giving you a high odds, right? So if something is like 50-50, you don't want to be trading on that, right? You want at least something that gives you a 60% probability, 70% probability. Okay? So a pattern itself, you break it down, you want to look up for two elements, right? Repeatability and reliability. Okay? So I think that hopefully that kind of help you understand a little bit in, reading a price chart, reading how price move, understanding patterns, the principle behind it, in terms of how I actually very quickly determine the direction of bias. Okay, so goal here, there's really nothing there. Okay,